Good evening, everyone. You're welcome to another edition of the Binance West Africa Newbie walkthrough. And it's very nice to be here today again. This session is basically for newbies that are new into crypto and that wants to build their knowledge and their skill in the crypto space. We will be helping you to learn how to use Binance, how to navigate the crypto space, and understand some crypto features and skills that you would need to navigate the whole space in years to come. So today I would be looking at cryptocurrency trading indicators, both the technical and social indicators. My name is Kazim Seidu. I'll be your host today. My co-host V is unavoidably absent, and I hope she will probably join us along the way. So I want you to just pay attention and follow me as we delve into cryptocurrency trading indicators. So um, let's just get right into it. Now, what are the types of indicators? There are mainly three types of indicators, which are the lagging indicators, the leading indicators, and coincident indicators. Leading and lagging indicators are tools that evaluate the strength or weakness of economies or financial markets. Now, in simple terms, lagging indicators are applied to long-term analysis based on historical economic performance or previous price data, while leading indicators can provide you information about trends that are yet to emerge. Now, in simple terms, leading indicators change in advance of an economic cycle or market trend, while lagging indicators are based on previous events and provide insights about the historical data of a particular market or economy. Now, I just want to break it down and make it simpler. Leading indicators provide predictive signals. That is, before the occurrence of market events or trends, they give you predictive signals which will prepare you as to what might happen in the market. Meanwhile, lagging indicators generate signals based on the market trend that is already underway. However, coincident indicators, this might be your first time of hearing that, and that is because they are less popular, but they're very important. They provide information about the current market situation. All these indicators, every indicators we have are all under these three main categories. An indicator can either be lagging, leading, or coincident. However, we could have some indicators that have both lagging and leading indicators in the system. So the indicators are used extensively by investors and traders who employ technical analysis. They are very important in stock, forex, and cryptocurrency trading. So all these indicators are used both in the stock market, the forex market, and the cryptocurrency market. Now, coincident indicators, just as mentioned, they are less popular, but they are somewhere in between leading and lagging indicators and work almost in real time. So they provide you information about the current economic situation, which can be very, very helpful for you for short-term trade positions. Now let's just go into how are these indicators used in technical analysis, which is our main bone of contention today. Technical analysis tools that are used by traders and chartists alike are classified as leading or lagging indicators. Those are the two main classes or classification of the indicators employed by technical analysts and traders who employ technical analysis in their trading strategy. In some cases, the two types of indicators may be present in a single chart system, as earlier mentioned. An example of such system is the Ichimoku cloud, which for instance comprised of both leading and lagging indicators. So that's an example of a system which uses both the leading and lagging indicators. So when used for technical analysis, both leading and lagging indicators have their advantages and disadvantages, which you must note and be aware of. So by predicting future trends, leading indicators would seem to you now to offer the best opportunities because it predicts future events. So it could seem to you as the best one to give you more opportunities. But the problem now is that leading indicators frequently produce misleading signals. Meanwhile, lagging indicators, they tend to be more reliable since they are clearly defined by previous market data. The downside to this now, to lagging indicators now, is that their delayed reaction to the market movement, in some cases, the signals may come relatively late for a trader to open a favorable position, which results in lower potential gains. So because lagging indicators, they are based on previous price and data. So it might take some time before you realize what is really happening in the market, and before you take position, you might have missed a lot of gains before you take position. So it will basically and mostly result into lower gains for you. So those are just the few advantages and disadvantages of these two types of indicators. Now, cryptocurrency trading indicators, which is what we will be looking at extensively today. There are two main types of indicators used in cryptocurrency trading, which is the technical indicators and social indicators. These two types of indicators, you must be very, very conversant with, and you should be aware and know how to use them, how to take opportunity when you see them. So technical indicators, I'll be taking us through four types of technical indicators today, which are the moving average convergence divergence, MACD, and the relative strength index, and Bollinger Bands. So these are the four types of technical indicators that I will be taking us through today. While the social indicators, the FOMO indicators, fear and greed index, Bitcoin dominance, and Bitcoin hash rate indicators. These are some of the examples of social indicators. Well, in actual fact, indicators are basically records or tools that help us to understand current market conditions and future financial, economic trends. So technical indicators are used extensively in technical analysis to predict the direction of a cryptocurrency's trends or price patterns. So I'll take that again. Technical indicators are used extensively in technical analysis to predict the direction of a cryptocurrency's trends or price patterns. So technical analysis takes into account a crypto's trading history and changes in price to predict future price movement. So both the trading history and the changes in price that has happened over time is what technical analysis tools use to predict future price movement. Technical analysis is different from fundamental analysis. Fundamental analysis focuses on a company's financials rather than historical price patterns or trends. Your type of trading strategy will determine the type of trading indicators you will choose for day, scalp, or swing trading, depending on the type of trading strategy you decide to employ. Now, popular technical analysis are indicators in traditional markets and cryptocurrency markets are the moving averages, the moving average convergence divergence, MACD, the relative strength index, RSI, and the Bollinger Bands. These are the four most popular technical analysis indicators that applies to both traditional financial markets and the cryptocurrency market. Although we have other indicators that are more specific to cryptocurrency markets, such as the social media indicator. These are more specific to the cryptocurrency markets. The FOMO indicators, the fear and greed index, the Bitcoin dominance, and the Bitcoin hash rate indicators, which I will tell us a bit about each of them just in a second. Let's take a look at the Bitcoin hash rate, for instance. Now, traders and non-traders tend to buy or sell assets when the price of an asset is increasing. So a high Bitcoin price now tends to result in higher hash rates because a high Bitcoin price means a higher rewards from transaction fees for the miners on the Bitcoin network. So more miners will want to join the network to make more rewards. So these are some of the ways whereby the Bitcoin hash rate also affects the sentiment of the people, of the traders in the market. When you have the information that Bitcoin hash rate is going up, it means more miners are on the network and are joining in order to get more rewards from transaction fees. Let's move on. Now, I want us to go into the technical indicators proper. The first one I'll be looking at is the moving average, which is simply referred to as simple moving average. There are two main types of moving average. the simple moving average, and EMA, which is the exponential moving average. The simple moving average, the common types are the three types I've listed, the three periods I've listed in the slide shown, which is the 200 period SMA, the 50 period SMA, and the 20 period SMA. Most traders who employ technical analysis and use MA, moving average, mostly use these three periods to influence their decision. Moving average indicators are based on past price data. Therefore, they are lagging indicators. So a moving average smooths out price action by filtering out market noise and giving the direction of the trend. So it is one of the most used indicators by crypto traders. The two most commonly used moving averages are the simple moving average, which is also called MA for short, moving average, and the exponential moving average. So the SMA is plotted by taking price data from the defined period and producing an average. How is that done? For example, now, the 10-day SMA, the 10-day simple moving average, is plotted by calculating the average price over the last 10 days. So the moving averages can be used for any time frame. So not just 200-day or 50-day or 20-day. It could be used for any time frame. But the most utilized, as I've mentioned, are the 200, 50, and 20 period moving averages, because these allow traders to identify the general direction of the crypto asset based on the selected period. Now let's look at how you calculate these moving averages. The 200 simple moving average is the average closing price of an asset recorded over the past 200 days. What you do is you simply add up the closing prices and divide the total by 200. Closing prices, that's the most important in there. In a candle, in a crypto price candle, you have the opening price, the close price, the lows, and the lowest price for that period, and the highest price. But to calculate the 200 simple moving average, you take the average closing price of an asset recorded over the past 200 days. Just add up the closing prices and divide the total by 200. That gives you the 200 period moving average. So this is for long-term traders who want to identify up or down trends while also getting a great idea of the support and resistance levels. So the 200 period SMA is mostly used by long-term traders. So it gives them the overview, the idea of where the market is heading to, and also to identify strong support and resistance levels. Now let me give us a guide on how to use the 200 simple moving average. An example is if the asset price is above the 200 moving average, the trend is up and bullish. If it is below, then the trend is down and you can call it bearish. A look at the 50 period SMA. This indicator is very popular among technical traders. It is helpful to identify support in uptrend, market uptrend, and resistance in downtrend. So the 50-day moving average is the average price that investors have paid for a cryptocurrency over the past 10 trading weeks or 2.5 months. And this is typically regarded as a support level. So I want you to get that very clearly. So the 50-day moving average, 50 period moving average, is the average price that investors have already paid for an asset over the past 10 trading weeks, which is same thing as 2.5 months. So the average price which investors have paid for an asset over the past 10 trading weeks. So when you get this 50-day moving average and plot it, it's regarded as the support level. So an important details to note is that there is something we call death and golden crosses. These death and golden crosses are recognized in the 200 SMA and the 50 period SMA. So if the 50 period SMA is crossing the 200 SMA from up to down, so it could be a death cross indication that a bear market is looming. So this is one of the ideas, one of the interpretation you get from these moving averages. So if the 50 moving average crosses the 200 moving average from up to down, it could be a death cross indication that a bear market is looming. So it helps you to take a decision to either still stay in the market and watch where it's heading to, or take your profit and stay safe in a stable coin position. However, if the 50 SMA is crossing the 200 SMA from down to uptrend, so that's a golden cross, and which might indicate an approaching bullish market. So for traders who can identify that, it helps them spot a good entry position into a crypto asset. Now let's look at the last one, which is the 20 period simple moving average. It allows traders to efficiently react faster to price changes because this is a short-term trading indicator in the market. So, and it allows traders to also trade breakouts because it manages to detect the low of the build-up before the actual breakout. So, however, it is important to note that this short movement can represent false alarms, things like the bull and bear traps. If you are trapped in a bull or bear trap, then you might record losses that you don't intend to lose. Now, having said that, having discussed this 250 and 20 period SMA, let us take a look at the exponential moving average, the EMA. There is a formula here as displayed, because EMA is a bit complex somehow in its calculation. However, you wouldn't need to have all this formula offhand because everything is readily available for you on the Binance trading platform. But this is the formula for you if you want to calculate the exponential moving average. So in the formula, you could see a variable here which is called smoothing, and smoothing is basically mostly the value is mostly 2. So the smoothing factor now, you can increase it if you want, and that's if you want the recent price observations to have a greater influence on the EMA technical indicator. And EMA is calculated in a way that gives more relevance to recent price data. So it makes it more reactive to recent price action. You could see from the graph of an exponential moving average, as shown, it usually consists of 3 lines. So whenever the candles are above the EMA lines, it represents an uptrend or a bullish signal. From the charts here that you're seeing, you can see how the yellow line, I believe you can see the yellow line, is reacting to sudden price changes in the chart. So the price of this asset remained bullish as long as it didn't come down enough to cross the purple line. When that happens, if the candle crosses that purple line, then the market might continue to fall. So this is why EMA is highly rated by traders, as it allows them to predict the next price by analyzing different price patterns of the asset in financial markets. I believe that is clear. Let's move up. So the next indicator that we'll be discussing today, this is the MACD. It's a very popular indicator. Almost every traders, no traders you talk to until they should mention just 3 indicators. Before they mention the second, they will probably name MACD. The full meaning of MACD is moving average convergence divergence. These words mean something, which we're going to look at as well. So the moving average convergence divergence indicator is also known as oscillator. So you could hear someone talking about oscillator. They are still referring to MACD. It's a very good buying or selling simple momentum indicator, and one of the most popular indicators used by crypto traders. So in short, MACD is a trend following momentum indicator. So it gives indications on both a trend and the momentum, the tendency for rising asset prices to increase further and failing prices to keep falling. That's just all it does. The MACD divergence, the divergence in the name of the indicator, it refers to the 2 underlying moving averages moving apart. In the MACD indicator, you have 2 lines, as shown in the slide here. You have this in this slide here, you're seeing a red line and a gray line. So the divergence simply refers to the 2 underlying moving averages moving apart while the convergence relates to the two underlying moving averages coming towards each other. So MACD indicator it tracks pricing events that have already occurred, and this makes it a lagging indicator. MACD indicator is generated. For you to generate a MACD indicator, if you're generating it yourself, all you have to do is subtract two exponential moving averages, two EMAs, to create the main line, which is the MACD line, which is the gray line in the screenshot. This is by subtracting the 26 EMA from the 12 EMA. The 26 period EMA, you subtract it from the 12-day EMA, and it is then plotted over the MACD lines, which is the 9 EMA, and termed the signal line. This is then used to calculate another EMA that represents the signal line, as you can see in the screenshot. Also, if you look at the MACD indicator very well, you notice a green this green histogram. So the histogram is calculated based on the differences between those two lines, the MACD line and the signal line. That's how you generate the histogram. Let's move on to the third one, which is the relative strength index, RSI. RSI is basically a momentum oscillator that measures the magnitude of price movements as well as the speed of these movements. So RSI is a momentum indicator, and it shows you as a trader is whether an asset is overbought or oversold. So when an asset is overbought or oversold, it means two things. If an asset is overbought, there could be impending pullback or retracement. However, if an asset is oversold, there could be another bullish retracement to the upside. So RSI achieves this by measuring the magnitude of recent price changes. The standard setting of RSI, if you want to use RSI, is to use the 14-day periods. So you use the 14 days, 14 hours. You have the settings when you're adding them on your Binance and trading platform. So the data now is then displayed to you as an oscillator that can have a value between 0 and 100. So since RSI is a momentum indicator, it shows the rate at which the price is changing. So the momentum is what it shows you. So this means that if momentum is increasing while the price is rising, then the uptrend is a strong one. I know that's very clear. If the uptrend, if the price is increasing, price of an asset is increasing, and at the same time the momentum is also increasing, then the uptrend at that time is very strong. So that means more and more buyers are stepping in. However, if the momentum is decreasing while the price is rising, so it may show that sellers will soon take over the market, and it could mean a bearish signal at that point. So a traditional interpretation of RSI is that when it is over 70, the asset is overbought, and when it is under 30, the asset is oversold. So that's just the basic interpretation of the RSI. So when you have the RSI above the 70 mark, it means the asset is overbought. And when you have it below 30 mark here, if the score is below 30, then the asset is oversold. In the same vein, extreme values like what we're seeing in the red portion here, or the green area here, the lowest and the highest part. So these extreme values now, what they could mean is that it could mean an impending trend reversal. If it's at the red point here, it could mean there could be a pullback. Or if it's at the green point here, it could mean there could be a bullish retracement back to the upside. So it might be best not to think about these values as direct buy or sell signals. So it is actually very good for you not to rely completely on this indicator, thinking when you see the score of an asset above 70, then it's overbought, or when you see it below 30, it's oversold, and you just take position immediately. So what you should do what you should do is combine it with other indicators. So, as with many other technical analysis techniques, the RSI may provide you false or misleading signals. So, it's always useful to consider other factors before before entering a trade. Aside from the RSI scores of 30 and 70, which may suggest potentially oversold and overbought market conditions, traders also make use the R support and resistance. I don't know if that is a very clear. So aside from you using the score of 30 and 70, you can also use the RSI to try and predict the trend reversals or spot the support and resistance levels of the crypto asset. So that approach is what is termed as bullish and bearish divergences. So when you use this approach, that means you are looking for something that is called the bullish or bearish divergence. What's a bullish divergence? Bullish divergence is a condition where the price and the RSI score move in opposite direction. So, for instance, if the RSI score rises and creates a higher lows, while the price falls, creating lower lows, so it's called a bullish divergence and can indicate that the buying force is getting stronger despite the price downtrend. So, despite the price of the asset falling, this could indicate that more buyers are stepping in and could mean that the price would go up anytime soon. However, the bearish divergence may indicate that despite a rise in price, the market is losing momentum. So the price could be increasing, but the momentum is decreasing. So this could mean a bearish divergence. So therefore, the RSI score drops and creates lower highs, while the asset's price increases and creates higher highs. Now, something you must note is that the RSI divergences are not reliable when you are in a strong trend market, but suitable for less volatile markets. So if you are in a very strong bullish market, the divergences that you see on the RSI might not really mean anything, and might not mean that the price will reverse or go back to the uptrend. So there could be a lot of noise coming from the signal. Now, to the last one, which is the Bollinger Bands. The Bollinger Bands, which is called BB for short, just a brief history about it, was created in the early 1980s by financial analyst and trader John Bollinger. So they are broadly used as an instrument for technical analysis. Basically, the Bollinger Bands work as an oscillator measurer. It indicates whether the market has high or low volatility, as well as overbought or oversold. From the screenshot that I've provided in the slide, we can see that the Bollinger Bands indicator is composed of an upper band, a lower band, and a middle moving average line. You could see the upper band, which is in blue, and lower band as well, which is in blue, and the middle moving average line in red. So the two side long bands in blue now, these things you can configure them. It doesn't have to be blue color, because we're going to check it out on Binance, and you would see that it doesn't have to be blue color, and you can change the color to suit your own preference. So what they do is they react to the market price action, expanding when the volatility is high, which means they move away from the middle red line, and also they contract when the volatility is low, thereby moving towards the middle line. So a standard Bollinger Bands formula, what you do if you want to use the Bollinger Bands, the standard way of using it is to set the middle line as a 20-day simple moving average, while the upper and lower bands are calculated based on the market volatility in relation to the SMA, which is known as standard deviation. So when you want to use Bollinger Bands indicator, the standard settings usually is like this. You set the middle line at the 20-day simple moving average, set the upper band at a 20-day simple moving average plus 20-day standard deviation twice. Same thing goes for the lower band, which you set it as the 20-day simple moving average minus the 20-day standard deviation twice. So let's just look at a simple overview of how to interpret the Bollinger Bands. If the price of an asset makes its way above the moving average and exceeds the upper Bollinger Band, it is probably safe to assume that the market is overextended or in an overbought condition. Or else, if the price touches the upper band, if it touches the upper band multiple times, so this may indicate a significant resistance level. So no, on the other hand now, if the price of a certain asset drops significantly and exceeds or touches the lower band multiple times, there are chances that the market is either oversold or the market has found a strong support level. So when the market price is moving sideways within both the upper and lower bands, so the Bollinger Band tends to narrow towards that simple moving average line, which is red in the middle. So usually, but not always, low volatility and tight deviation levels precede large explosive movements, so which tend to occur as soon as the volatility picks up. An example here is, you could see from this screenshot here, when the volatility was very low, there was a very tight space between the upper and lower bands. So when the volatility picks up, there was an explosive price action up to the upside. So that's what we're trying to explain in the last statement. Now, having said that, I want to believe we've been able to understand how and what these technical indicators mean. Now, I want to show us the technical indicators one after the other on the Binance trading platform. We're going to use the spot trading area as an example. Okay, let's go to Binance.com. Okay, then let's access this the spot trading section. All right, we are on the BTC USDT spot market. We're on the BTC USDT spot market. Now, this is our trading chart. Let's make it a full screen so we could see very well. This is the BTC USDT chart. These are the candles. Okay, I'll need to take it back to short screen so I could add the indicators. Okay, all right. So now we could see it very well. This is the BTC USDT chart. Now I want to add one of the indicators. Let's start with the Bollinger Bands. To add an indicator, all you have to do is tap on this setting icon. You could see here, technical indicator. It's labeled technical indicator. And one thing to mention as well is the time frames. When you're on a trading chart, the one you're looking at represents a time frame. This is currently a weekly time frame of BTC. This is why the 1 week, the 1W here is highlighted in yellow. You can change it to another time frame you want to analyze. I could decide to change it to 1 day, which is the daily time frame. This is the daily time frame for the BTC USDT trading pair. You have the 4 hour, you have the 1 hour. The lower you go, the more noise you have on the chart. You have the 15 minutes. Also, you can access some other time frames that are not listed at the top by tapping on this small arrow. Just tap on the small arrow or over on it, then it will display to you all other available time frames. Here we could see we have the 6 hour time frame, 3-day time frame, 30 minutes, up to 1 minute, and you also have 3 minutes, 8 hours, 2 hours, 5 minutes, 12 hours, 1 month. So you're able to navigate through different time frames for any particular trading pair. So for this example, Let's switch to the 4-hour time frame. We're on the 4-hour time frame. We want to apply the Bollinger Bands to see how it behaves on a trading chart. Let's tap the technical indicator. You have the Bollinger Bands here, which is BOLL. Let's tap on the Bollinger Bands. Okay. Here we have it. So when I tap on the Bollinger Bands, I have the settings here. So which I mentioned the other time that you can configure the color of the lines. So I could decide that this line, I want it to be white. And also the lower band line, I want it to be white as well. The middle band, I could change it to red or any color that I think would suit my preference, that I will be able to see very well on the chart, especially for visually impaired users. Okay, so let me save. Now I have the Bollinger Bands on my chart. Let's zoom in. Let's zoom in and see if we can see an area with very low liquidity and see what happens after such time. Okay, this here, we could see this area. This area happens to be a time where there was a bit of low liquidity and tightness from the standard deviation. So the lower and upper band moved, they contracted and moved towards the middle line during this period of time, from this area to this area, before the price took a bit of explosion up to the upside before correcting back to the downside again. So if you're using the Bollinger Bands, it could have given you an opportunity to enter the market anywhere here. So let's assume you enter the market from this area, then you could have made some profit at this point before the market reverses. Now this is how Bollinger Bands looks on the chart. So I believe everyone is saying it. Now to remove an indicator from the trading chart, all you have to do is search for the name of that trading indicator here and just tap on close. So when I tap on close, then the trading indicator, the Bollinger Bands, disappears. So if I don't want to have multiple indicators on the chart at once, then I could do that to remove the trading chart. The second indicator that we want to look at is the moving average. The moving average. So if you remember very well, the moving average, we talked on the 20-day simple moving average, the 50-day simple moving average, and the 200-day simple moving average. Here you can configure the color. Let's configure the color so we can see the lines very well. I want my 20-day moving average to be white. I want my 50-day moving average to be blue, and want my 200 moving average to be yellow. Let's give it yellow. So let's not forget, our 20-day moving average is white, 50-day is blue, and 200-day is yellow. So these are some of the features that Binance offers. You can configure your trading indicator, their appearance from the Binance and from the trading area. So I have the white, blue, and yellow. So my 20-day moving average is this. This is the line, this white line, and the 50-day moving average is the blue line, while the yellow line is the 200-day moving average. You could see from this chart that the 200-day moving average doesn't really offer so much ideas about the market, because it's basically for long-term traders. For you to actually see the effect very well, you probably want to go to a higher time frame and see based on the history of the market where it's probably. So even at higher time frame, you could not see the 200 days at all, because the trading has not been on for so long that it will require to have the 200-day moving average. But on the 4-hour time frame, we have the 200-day moving average lines here, but it's not offering too much of hints about how the market is moving. So this is the 50-day moving average and the 20-day moving average. So this is just basically how it looks. In subsequent classes, we're going to go deeper into how you can use them and interpret them properly. Okay, let's take a look at another indicator. Let's remove this moving average. And by just checking the name here, which is the MA 20, I have this, then we can just tap on close. Another indicator we want to add is the EMA, the exponential moving average. The exponential moving average. Just like we've mentioned, we mentioned that the exponential moving average, the EMAs, also consists of 3 lines, which are basically the 20 EMA, the 50-day EMA, and the 200-day EMA. Just like we configured the other one, let's configure this as well and put the 20-day EMA make it white, make the second one, which is the 50-day EMA, make it blue, then make the 200 EMA, we'll make it yellow. So white, blue, yellow. So we have the 20-day EMA here as the white line, the 50-day EMA as the blue line, and the 200-day EMA as the yellow line. You could see some similarities between them. But one particular difference is the reaction of the 20-day EMA to sudden price changes, which you can see the white line, how it reacts to price movement. It reacts suddenly, just like what we are seeing here now. The way it reacts suddenly to price changes, it's what makes it a bit different from the moving average. I believe that's very, very clear. Okay, we talked about RSI and MACD. Let's check them. Let's reduce this. Okay, so you could toggle between full screen and the normal screen time. Okay. Okay, I don't know if anyone noticed what I just did there. If you look at the top here, you have the original trading chart. You have the trading view trading chart. Trading view is like it's integrated into the Binance chart area. Trading view as well, you can access it through tradingview.com, where you can get extensive research on trading charts. Now let's see something. This is the volume here represented down here, but we want to add our RSI and MACD. So let's go to the same technical indicator icon. But here you wouldn't select, just type, search for it. You can search for MACD. Let's select MACD. So immediately we select MACD, it is inserted here. It's inserted here. So you have it here. You can see. So we have the MACD line, which is in red, and the signal line, which is in blue. All right. So just like we mentioned while we were talking, so you have the MACD line, which is calculated by deducting the 26 EMA from the 12 EMA, which is also stated here, just for informational purpose. So this is the MACD, and these are the histograms in red here. These are the histograms. Okay. You can also do some settings and configure it any way you think you like, changing the colors. And how do you do that? Just tap on the indicator and click on settings on the menu here, then tap on settings to configure how you want it to look, how it will appeal to you more. So here you have the MACD line in blue and the signal line also in red. The histogram, you could decide to leave them in red or change them to, let's say, blue, a deep blue line. And also you can even change the thickness of the histogram. While the MACD line as well, you can change the color to, let's say, white. And the signal line, you can leave that in red. So we have the MACD line, which is white, and the signal line in red. I made a mistake then the other time. So you could see from this seeing the indicator now, when the MACD line crosses the signal line to the upside, it indicates a bullish movement. Meanwhile, when it crosses the signal line to the downside, it indicates a bearish movement. However, you must know that MACD line is a lagging indicator. What you are seeing is based on past previous price data. So it's not giving you anything that is going to happen or will happen in the nearest future. It's based on past price data. So same way, we could add the RSI to our chart. We could add the RSI. I've just removed the MACD just to allow us add the RSI. Tap on the technical indicator and search for relative strength index. Tap on it, it will be automatically added to your chart. So we have the RSI here. We have the RSI here. Now you can see it's already names. At the top line here, the highest area here is the 70 mark. If you remember very well during my explanation, the RSI, the value that is of utmost concern to you is between 30 and 70. So when the prices and when the score of an asset drops below 30, it's assumed that the asset is oversold. When it goes above 70, then it is assumed as well to be overbought. Same way you can configure the MACD or any other indicator, you can also configure the RSI if this color is not really appealing to you or you're not seeing very well. You can just tap on the RSI name, come to the menu, and tap on settings to change the colors. So you have the plot line, which is the RSI line. We can make it white. You can make it white. So you have the upper limit line at 70. If you want to increase it for your own purpose, you can, but the standard score is 70 for the upper limit, and the lower limit, the standard score is for 30. Also, you can change the background to reflect more of probably the way you want to see it. So I choose green for that. So let's tap on OK. See, I could change the look and change how I want it to display for me. So now for these assets now, presently the RSI value is around 70. It's already around 70 area, and we could see some reaction there, which means the price of the asset could drop a bit. That BTC could drop a bit from that level down, and it could still go up. So that is why it was mentioned in the explanation that you don't want to totally depend on what this RSI gives you, because it could give you false alarms like bullish and bulls and bear traps at any time. So all you want to do is combine it with other technical indicators to arrive at a solid decision before you take position in any crypto market. So that's that about RSI. So what I want us to do now is to take a few questions that you might have, and let's see if we can answer a few ones. Thank you very much. So let me check for some questions that we might have. All right. So I have a lot of questions here. Okay. Okay. All right. Sam Braga said, he's asking, he said, which is the best, technical analysis or fundamental analysis? Excuse me, before I answer the question, I want to encourage us to fill the giveaway form. The link is posted already in the comment section. You can scroll up to check the link. Fill it with your BUID to be able to win from a giveaway of 100 BUSD. Also, don't forget to join our community, the Binance Nigerian group or the Binance Ghana group. So to join the Binance Nigerian group, it's at Binance Nigeria, while for Binance Ghana is at Binance GH Binance. Please join the communities to get updated about upcoming events and also promotions. Thank you. Now to the question, which says, which is the best one, the technical analysis or fundamental analysis? Fundamental analysis and technical analysis are different technical in their different trading indicators. Fundamental analysis, what it does is based on the financials of a company. Financials of a company, while technical analysis is based on price data and patterns. So there are two different things, but it depends on you as a trader. Your own strategy will determine which one you use most. There are some traders that depends mostly on fundamental analysis. And fundamental analysis, those kind of traders follow events. They follow what is going on with a project. They follow the news and know what's going to happen. Probably there is a meeting of SEC or Fed. They want to know what the outcome is and how it will affect the market. So traders that use fundamental analysis most follow news and want to know what's going on with the project, the utility of the project, and upcoming events of the project. However, everyone should be conversant with fundamental analysis and should also know the fundamentals of projects they are getting into or they are part of. While technical analysis, it employs the use of technical indicators. And technical indicators can help you predict the movement of the market the price. They can help you predict the future price movement of a crypto asset and give you probably an idea of where to take position and where to take profit in the market. So it depends solely on you as a trader. Your own trading strategy will determine which one you use or you consider to influence your decision most times. I believe that answers the question. The second question I have here from Muhammad Najib. He said, how do a miner get rewarded from a Bitcoin transaction? Every Bitcoin miner, we all know that Bitcoin is a proof of work coin, which means there are certain miners, there are miners or nodes on the Bitcoin network. So when they mine to solve the transaction puzzle, to generate a new Bitcoin, they get rewarded through transaction fees on the Bitcoin network. So they get rewarded from transaction fees when you send Bitcoin, when you do any transaction on the Bitcoin network. The transaction fees generated is distributed to the miners that are put to solve the puzzle at that moment to generate blocks of the blockchain Bitcoin network. So where they get is from transaction fees is where they get their rewards. Okay, what is SMA? SMA is simply simple moving average. Simple moving average. Thank you. So I think another question here is this. Okay, this question is saying, what if it's a newly listed coin? How many SMA period someone needs to consider? For a newly listed coin, definitely doesn't have much price history. So that is why for a newbie, you are mostly advised to stay away from newly listed coins because they are mostly highly volatile at that point, and they don't have much history. They don't have enough history for you to decide on or to even know where they may head to. So a coin could be listed now, it could jump up to 1,000%, drop by another 500%. So they are very volatile, and I don't have enough data for you to decide on an entry position. Okay, Samuel Alagbe said, you mentioned breakout in the 20 EMA, I believe EMA. So what is the meaning of breakout? So breakout simply is, let us assume an asset has a resistance level. Let's say BNB has a resistance level at 200 USDT. So now BNB price has been hitting that point and getting rejected for a point for some time now, for a period. So at some point, BNB price will probably break out of that resistance level to the upside, probably to, let's say, 210 USDT. So that breakout now, some traders take advantage of it when they already noticed that the price of the asset is touching that resistance level multiple times, and there could be possibility of it breaking out of that resistance level, considering other factors in the market. So they may take a position at that point to trade that breakout. When the price breaks out of that level, then they take profits at the upper side. Okay. All right. Okay. Sam Alabi just wants to call. He said, if the price of an asset is increasing with the momentum, that signifies bullish. Yes, it signifies bullish. If the price of the asset is increasing and the RSI momentum as well is increasing, then the trend is assumed to be strong at that moment and can be termed as a bullish signal. Okay, Farouk said, among all these indicators, which one is more important in red market? Well, I don't think I can give you a definite answer to that. Your decision solely relies on your trading strategy. But one of the best approach to surviving in the bear market is to manage your risk exposure. Don't be too exposed. Manage your assets and use a little percentage of your portfolio to take position. So that's just the only advice I could give you. And also, we should be aware that everything we say here is not financial advice, but to be seen as educational material. Okay. Oh, okay. A question here also said, I learned that when an asset is overbought, it dips to 2-3. like two-third before it reaches oversold. So take example, bond coin did this month, but I'm right. Okay, well, when an asset is overbought, like I mentioned, RSI could give you false alarm. You could be seeing an asset RSI score over 70, and it could still go up a certain percentage. The price could still go a certain percentage from there. Meanwhile, you might have taken your profit at that 70 point. So you need to use more indicators to take proper decision. Okay. And there is no definite rule that says that when an asset is overbought, it will definitely fall at all. It might not even fall before it goes before you see it move up again. So you just have to use more indicators to actually be able to take better okay. Okay, Okunwo said what used to cause a to be very volatile? Is it because people are trading it a lot at the moment? Well, for a newly listed coin, they are always very volatile, especially when the coin has probably great utility and many people are already anticipating to also take part of the trading at that point. So at that point, when a coin is newly listed, a lot of people are coming into market. So it depends. If the coin has already been sold, probably at an ICO state to some group of people, those group of people will want to probably sell at the point of listing. However, if a coin probably is very rare, has not been sold to anyone whatsoever, at the point of listing, the price could jump up over 1,000 percentage because a lot of people wants to buy at a time. So more people are coming into the market. So it's very, and it's advisable for newbies to stay away from newly listed coins if they don't really know what they are doing. So that will be the last question for today. Thank you very much for being a part of this session. It's really, really nice, and I hope that you join us again next week. This happens every Thursday. The newbie West Africa newbie walkthrough happens every Thursday at 6 p.m. GMT. So we'll give you free knowledge on how to use Binance, how to navigate the crypto ecosystem. Please join us. Share this with your friends. You can also just visit, check other videos, other on previous sections that we have already done on how to register a Binance account, how to trade spot, and other things that we have already discussed on our past session. Check the Binance Africa YouTube channel to watch these videos and share with your friends. Let them join us next week for another edition on this same Binance Africa YouTube channel. So we'll be expecting you. Thank you very, very much. Also, aside from the newbie walkthrough, we have other events as well. Please join the Binance Nigeria group at Binance Nigeria on Telegram, or the Binance Ghana if you're from Ghana at Binance GH Binance. So you can get updated information on what is happening and what's going to happen. If you would like to follow me on Twitter, my Twitter handle is at Seidu K _ official, SEIDUK _ official. You can follow me on Twitter to get updated on what's happening on Binance. And also, if you have any question or need any help regarding Binance ecosystem, I will be very, very happy to assist. Thank you very much. About the reward, kindly fill the giveaway form and expect your reward in about 1 week to 2 weeks time. So please note, when you fill the form, your reward doesn't come in immediately if you are selected or if you win. Your reward comes in at exactly around 2 weeks. Just give it 2 weeks time, then you possibly get your reward if you win. Thank you very much. My Twitter handle is Seidu K SEIDUK _ official. Thank you very much. See you next week. See you on another event. Thank you very much. Have a nice week.